Hello everyone. Our subject is Auditing and Assurance as per NEP 2020 from MCOM Part-2 Semester 4. Our question is, explain the importance of ethics in accounting. Ethical behavior in accounting is not just a matter of professional responsibility, but a necessity for the efficient functioning of financial markets and corporate governance, which means being ethical in accounting isn't just something accountants should do because it's parts of their job. It's something they must do. Why? Because the entire financial system depends on it. If accountants are honest and follow the right principles, then people can trust financial reports. This helps companies run properly, investors make good decisions, and the market stays strong and stable. So, ethical behavior in accounting is not optional, it's necessary for everything to work smoothly in the world of business and finance. Our first point is maintaining public trust and confidence. Financial statements serve a crucial source of information for investors, lenders, and regulatory authorities. Ethical accounting practices build trust and confidence among these stakeholders, ensuring that financial decisions are based on accurate and reliable data. Conversely, unethical practices such as falsifying reports or manipulating earnings can lead to a loss of credibility and stake public confidence in financial institutions, which means financial statements are very important because they give useful information to people like investors, banks, and government authorities. These people use that information to make big financial decisions. Now, if accountants follow ethical practices like being honest and showing correct numbers, such as these people can trust the reports. It builds their confidence in the company. But if an accountant does something wrong, like changing the numbers or hiding losses, then people lose trust. It can damage the company's reputation and even affect the public trust in the financial system. So, always remember, ethical accounting helps build trust, while unethical behavior destroys it. Our second point is preventing financial fraud and corporate misconduct. Adherence to ethical principles in accounting helps prevent fraud, misrepresentation, and manipulation of financial data. Ethical accountants ensure that financial reports provide a true and fair view of an organization's financial position, reducing the risk of corporate scandals, which means when accountants follow ethical principles, they make sure not to cheat, lie, or change any numbers in the financial report. This means they don't hide losses, don't show fake profit, and don't try to make the company look better than it really is. The accountants always prepare reports that show the true and fair picture of how the company is doing. This is very important because investors, banks, and even the government depends on these reports to make decisions. If the reports are false, it can lead to big scandals like we have seen in some famous companies fraud in the past. But if the accountant is honest, these problems can be avoided. In simple, ethical accounting protects company from fraud and helps everyone trust the financial information. Our third point is ensuring legal and regulatory compliance. Financial reporting is subject to numerous laws and regulations include International Financial Reporting Standards, IFRS, Generally Accepted Accounting Principles, GAAP, Companies Act 2013, India, Sarbanes-Oxley Act 2002, USA. Ethical accountants ensure compliance with these legal frameworks, minimizing the risk of financial penalties, lawsuits, and regulatory actions against the organizations. Which means when companies prepare their financial report, they have to follow many rules and laws. Some of the important ones are IFIs. These are international rules used by many countries to make sure financial reports are clear and consistent. Next, GAAP. These are common rules used in countries for prepare financial statements properly. Next, Companies Act 2013. This is the law in India that tells company how to manage their finances and reportings. Next, Sarbanes-Oxley Act 2002. This is the law in the USA made to stop fraud and protect investors after big company scandals. Now, if accountants follow ethics and do their work honestly, they will also follow these laws correctly. This helps the company avoid fines, legal troubles, or action from the government. So, ethical accounts helps the company stay within the law and protect it from the big problems. Our fourth point is promoting transparency and accountability. One of the core objectives of ethical accounting is to eliminate financial opacity by ensuring that financial statements are clear, accurate, and easy to understand. This allows investors and regulators to hold management accountable for the company's financial decision, which means one of the main goals of ethical accounting is to make sure that financial reports are clear, correct, and easy to understand. This means there should be no confusion or hidden information in the reports. When financial statements are honest and simple, it becomes easy for the investor, governments, authorities, and others to see how the company is really doing. They can then hold the company's management responsibility for any financial decisions they make. So, in simple, ethical accounting helps remove confusion and make sure that it is truth and truth is shown clearly in financial report. Our fifth point is safeguarding the interests of stakeholders. A company's financial report affect a wide range of stakeholders include investors. Ethical accounting helps investors make informed decisions regarding stock purchase and business investments. Creditors and lenders, banks, and financial institutions rely on accurate financial data to access a company's ability to repay loans. Regulatory authorities, government agencies use financial reports to monitor corporate financial health and ensure tax compliance, which means a company's financial statements are not only important for the company itself but also for many others who depend on the information. For example, investors. Investors use these reports to decide whether they should invest in the company or not. Ethical accounting helps them make informed and safe decisions. Then we have creditors and lenders, like banks and financial institutions, who use the reports to check whether the company can repay the loans. If the reports are not honest, it could lead to wrong decisions and financial loss. Lastly, regulatory authorities, such as government departments, also rely on this report to monitor the company's financial health and to make sure it paying tax properly. That's why it is very important for accountants to follow the ethical practices and prepare the proper reports that are true, clear, and accurate. It builds trust and helps everyone connected to the company make the right decisions. Our sixth point is avoiding legal consequences and financial losses. Unethical accounting practices can lead to legal penalties, loss of reputation, and financial disaster. Many companies that engaged in fraudulent accounting have faced criminal charges, heavy fines, and corporate bankruptcies, which means when a company uses unethical accounting, like lying in financial reports or hiding losses, it can lead to big problems. Such companies can face legal trouble like court cases and heavy fines. In some cases, the people involved may even face criminal charges. Also, when the truth comes out, the company's reputation gets damaged and people stop trusting it. This can cause a huge loss of money and it may causes the companies may even go bankrupt or shut down completely. So, in simple, cheating in accounting may bring short-term gain, but it causes long-term damage to the company. That's why following ethics is so much important. Conclusion: ethical accounting is very important for any businesses. It helps build trust, prevent fraud, follows legal rules, and keep things clear and honest. When companies follow ethical practices, They protect their interest of everyone, like investors, banks, and the government. This all also helps the company avoid legal trouble and money loss. Being honest is accounting leads to good reputation and long-term success.